Good day, my name is Chang Ming, Head of Fixed Income Strategy at RHB Bank, Group Treasury and Global Markets. Today, I would like to share with you our outlook on the fixed income space as we navigate 2020 from a tactical perspective. 2020 has been an unprecedented year amid lingering concerns over COVID-19 pandemic, which has amplified the downside risk to global and domestic growth prospects. Despite a more challenging macro backdrop, we believe that there are strategies that we can embark on given the prevailing low interest rate environment and benign inflation outlook, which remains supportive for fixed income investments. We hope you will find this podcast useful in helping you navigate 2020 better. Given the increased downside to growth, global central banks have started to renew quantitative easing again to complement fiscal support as global growth is expected to contract in 2020. The US Fed announced plans for unlimited quantitative easing, whilst the ECB expands bond buying program to Euro 750 billion. As a percentage of GDP versus balance sheet size, the levels for the BOJ, ECB, and US Fed are at 112%, 45%, and 31% respectively. The outlook on growth has turned less optimistic, with IMF slashing global growth to -3% in 2020, US -5.9%, Eurozone -7.5%, and emerging Asia to 1%. For next year, global growth is projected to improve at a pace of 5.8% in 2021 as economic activity normalizes, aided by fiscal and monetary policy support. The growth recovery in 2021 are based on the assumptions of improved COVID-19 containment in second half 2020 with the gradual reopening of economic activities. For Malaysia, we expect domestic growth to moderate with a likely second quarter GDP contraction due to reduced economic activities from MCO implementation since mid-March. Gradual reopening of economic activities is expected to pave the way for growth recovery in the second half 2020. For the first quarter 2020, Malaysia's growth moderates to 0.7% year-on-year versus 3.6% in fourth quarter 2019. In the ASEAN region, increased downside risk to growth has emerged due to COVID-19, but Malaysia is still better positioned compared to its peers. Thailand's first quarter 2020 GDP contracted -1.8% year-on-year, while Singapore contracted -2.2%. Malaysia's first quarter GDP print moderated, but still remains in positive territory. Given the need to support domestic growth, Bank Negara's OPR was recently reduced to 2%, a level last seen in 2009. On year-to-date basis, the OPR has been reduced by a total 100 basis points. BOP Bank Negara's accommodative monetary policy stance remains supportive of growth and complements the government's fiscal measures. The latest CPI reading in April came in lower than expected, contracted by -2.9% year-on-year versus consensus estimates of -1.6%. This marks another consecutive negative CPI print after March -0.2% print. The subdued inflation outlook is expected to keep bond yields lower given the current backdrop of lower oil prices. As efforts to boost liquidity, the SRR was reduced to 2%, with flexibilities announced to allow MGS and GII to be included as eligible assets for SRR computation. We expect this to boost liquidity and increase govies demand. Bank Negara announced further inclusiveness for MGS and GII for SRR computation to include all banks, leading to release of additional 16 billion liquidity into the financial system. Since March 2020, Bank Negara has provided additional liquidity of approximately 42 billion into the domestic financial markets via various tools, including outright purchase of government securities, reverse repos, and the reduction in SRR. A recap: MGS and GII flexibilities for SRR computation was previously given to principal dealers during the March announcement. Further inclusiveness announced in May is expected to bode well for local govies demand. We expect 10-year MGS yields to tighten further from OPR and SRR cut. Here is a snapshot of key events driving 10-year MGS movements. April 2019, 10-year reached high of 3.94% after FTSE Russell put Malaysia on waiting watch on potential exclusion from Week B. January 2020, Bank Negara cut OPR by 25 basis points to 2.75%. March 2020, Bank Negara cut OPR by another 25 basis points to 2.5% and the SRR was reduced to 2% with flexibilities for principal dealers to include MGS and GII for SRR computation. Mid-March 2020, the flight to US dollar safe haven due to COVID-19 outbreak and global growth concern resulted in 10-year MGS to surge above 3.6%. April 2020, MGS yields recovered in April after FTSE Russell maintains Malaysia and Big B. May 2020, the flattening COVID-19 curve and OPR cut of 50 basis points to 2% supported bond yields to trend lower. Following the recent contraction in April CPI print, 10-year MGS extended gains in price terms with yields hovering at 2.8% region. In terms of fixed income strategy, the 10-year MGS versus 10-year US Treasuries offers good spread of above 200 basis points. We expect increased demand for ringgit bonds from a carry perspective, with a flattening COVID-19 curve as an added plus point. Values are emerging for ringgit bonds as real yields are still attractive due to lower inflation outlook. Foreign holdings moderated in April, but at a lesser amount of ringgit 2.3 billion compared to ringgit 12.4 billion observed in March. Total foreign holdings of government bonds stands at 21% in April. The moderate reduction in foreign holdings was supported by unprecedented quantitative easing by global central banks and recent Bank Negara measures. Local onshore support continues to remain healthy, reinforced by strong bid-to-cover trends from concluded year-to-date MGS GII auctions. Year-to-date bid-to-cover average stands at 2.39 times, which continues to reinforce our views. From an issuer's perspective, we believe there are good liquidity windows for issuances from June to August and October from maturing government bonds, corporate bonds in the coming months. Funds from scheduled maturities will be returning as reinvestment flows and as such good pricing windows for new primary bond issuances. In conclusion, a summary of our key takeaways from our outlook: gradual relaxation on lockdowns, possible vaccine discovery, and reopening of economic activities by more countries will help support growth recovery in second half 2020. Additionally, we expect the accommodative monetary policy outlook and benign inflation to augur well for bond issuance momentum and fixed income investments. The low interest rate environment and ample liquidity in the financial system are key positives to explore fixed income investments as a defensive asset class during this challenging economic environment. Thank you for listening to our podcast. We hope you find the drivers mentioned helpful in your investment and business decisions.